Starting a fund of funds can be very rewarding as well as challenging opportunity for financial entrepreneurs who want to start their own hedge fund. Instead of managing trade, evaluating different asset classes, the fund manager has the task of researching and choosing which hedge funds they wish to invest in based on various risk parameters. In this video, I'm going to share with you what is a fund and how you can set one up. Hey, it's Frank Nagy and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. A fund of funds is a pooled investment vehicle where the fund's investors' capital is allocated to a predetermined number of other hedge funds with varying strategies. Rather than selecting individual stocks and bonds to invest in or participating in riskier strategies like early stage venture, growth, equity, and late stage buyout, a fund of funds performs due diligence on active managers to invest. Most of the due diligence conducted by fund of funds focuses on four areas: the fund manager, asset class allocation, sectors and industries, and trading strategy. The primary objective for all fund of funds is to identify the right hedge funds to allocate capital in order to maximize returns, while simultaneously managing the downside risk by spreading the capital across different hedge funds, strategies, sectors, and asset classes. One of the main benefits for investors that invest in fund of funds is diversification. Since the fund of funds risk in its portfolio is reduced by holding investments across a broad set of asset classes and investment strategies. Since fund of funds interest invests in active managers, the fund has indirect exposure to not just one but several active fund managers. Many high-performing hedge funds will often ignore inquiries from individual investors due to the small size of investment in the fund. But with a fund of funds, this process is bypassed since the fund can invest with a larger amount represented by multiple investors. In fact, individual and small institutional investors that might not meet the requirements for a large fund and to be a limited partner can participate and be grouped together and invest through that fund. Since capital is invested into active fund managers, there are two layers of fees: fees of the underlying hedge funds and the fees of funds. Typically, a fund manager can charge anywhere between 0.25% to 1% annual management fee, with the performance fees ranging from 0.5% or 5% or up to 15% per year. The fund of funds fees is placed on top of the fees charged by the underlying hedge funds in the portfolio. The standard structure for most hedge funds are 2% annual management fee and 20% performance fee or carried interest. This is also known as the 2 and 20. Due to the double fee structure, investors of funds can expect a lesser return on their investment compared to investing in separate hedge funds. If you're considering starting a hedge fund or fund of funds, then hiring an experienced hedge fund consultant like Frank Nagy Financial Services can help reduce the burden of setting up your fund of funds. A good consultant will provide advice on selecting the right hedge fund to invest in, as well as making the proper introductions with attorneys, auditors, administrators, and prime brokers who will help your fund grow.